Imagine waking up one morning, opening your trading app, realizing you could own shares of a US-listed company for the price of a bottle of water. Just $1. Sounds almost unbelievable, right? Well, picture this. What if that tiny $1 share suddenly climbed to $2, or $5, or even $10? That small amount you invested could turn into something much bigger. This possibility is what keeps millions of investors scanning the US stock market for cheap, low-priced opportunities. In today's video, we're diving deep into the world of stocks, trading around just $1 what they are, why they're so attractive, and why they're often one of the riskiest corners of the market. Stay with me, because by the end of this video, you'll know what to look at before buying any under $1 stock and how this type of investing works behind the scenes. And trust me, the stocks we'll talk about today may surprise you, because some of them belong to real companies with real products, real employees, and sometimes even real future potential. But there's a twist. Low price doesn't always mean cheap deal. Sometimes it means high risk, and that's exactly why this video matters. Before we jump into charts, examples, and analysis, let's set the stage. When we say a company has a stock worth around $1, it doesn't always mean the company is new or unknown. Many U.S. companies fall under this price because of market conditions, revenue struggles, debt pressure, or sometimes just lack of investor attention. They trade in a zone known as penny stocks, a place full of high volatility, big swings, and unpredictable movements. Some investors see them as lottery tickets. By many, hope one explodes. Others treat them as early-stage opportunities, a chance to get in before the crowd notices. But here's the truth. Behind every success story of a penny stock turning into a multi-dollar giant, there are hundreds of companies that never grew, never recovered, and eventually disappeared. That's why research matters, risk awareness matters, and patience matters even more. In this video, we're not just listing companies under $1. We're understanding the mindset needed to approach this space. If you're someone who loves exploring hidden gems in the market, or if you're curious about how people make money trading low-priced shares, this video is made exactly for you. Get ready, stay sharp, and let's enter the world of $1 US stocks, where opportunity meets uncertainty, and every decision counts. Now that we've set the foundation, let's move deeper and unfold what these $1 stocks really are and why they exist in the first place. When a company trades around $1, it usually falls into the category of microcap or penny stocks. These are companies with smaller market capitalizations, often in early growth stages, experimental industries, or going through financial challenges. Imagine a startup working on a new biotech solution, an energy company trying to survive in a competitive environment, or a tech company that once had hype but lost momentum with time. These are the types of businesses you commonly find trading around the $1 zone. Some are fighting to grow, some are restructuring, and some are simply hoping the market notices them. And because they're cheaper, they naturally attract beginners and budget-conscious investors who want to feel involved without needing hundreds of dollars for a single share. But let's talk about why people rush toward low-priced stocks. The biggest attraction is affordability. A beginner with just $20 can buy 20 shares of a $1 stock. It feels empowering. Holding multiple shares gives a sense of ownership and potential. And the most tempting part is the upside. If a $1 stock climbs to $2, that's a 100% return. If it reaches $5, that's 400%. These numbers create excitement, hope, sometimes even greed. Many investors dream of catching the next big thing early, before the rest of the market realizes its value. The story is simple in their minds: buy low now, sell high later. And yes, it can happen. History has examples of small, unknown companies turning into million-dollar giants. But the part most people ignore is that for every success like that, there are countless cases where small companies don't grow at all. This brings us to the reality check. Cheap stocks carry cheap prices for a reason. High reward comes with high risk, and penny stocks are one of the riskiest areas of the market. These companies may have unstable revenue, incomplete business plans, management issues, debt problems, or limited future potential. Their prices move quickly, sometimes up sharply, but often down just as fast. A single announcement, a quarterly loss, a lawsuit, or even market rumors can send these stocks crashing in minutes. And because trading volume is often low, it can be hard to buy or sell without affecting the price. Sometimes you might want to exit a position, but there aren't enough buyers. The stock becomes like a trap. Some companies even get delisted from major exchanges and move to OTC markets, where transparency is far lower. So how do smart investors approach this type of stock? They don't blindly purchase based on price. They research. Instead of asking, "This stock is $1, should I buy it?" they ask deeper questions. What does the company actually do? Are they generating revenue or just promising future potential? How much debt do they have? Has the stock price fallen recently, and why? Is the company improving or declining? They check financial statements, news, investor presentations, and trading volume. They try to understand the story behind the price, not just the price itself. A $1 stock with strong fundamentals and growth potential could be an overlooked opportunity, and a stock priced at $1 because the company is collapsing might be a ticking time bomb. The strategy for dealing with penny stocks often involves diversification and risk control. Experienced traders rarely put all their money in one cheap stock. Instead, they spread across multiple companies. Treat penny stocks as a small higher-risk portion of their portfolio, and never invest more than they can afford to lose. They think long-term, stay patient, and avoid emotional trading. They use stop-loss orders, track earnings reports, and follow industry news closely. Some traders also aim for short-term momentum plays, riding quick waves instead of waiting for long-term growth. But that requires skill, discipline, and constant monitoring. What's interesting is that low-priced stocks continue to exist in the market, year after year, because new companies keep entering the market and old companies fall in price. The stock market is alive every day. Businesses rise and fall. Some companies move from $1 to $10 over time due to innovation, new products, or market expansion. Others slowly fade out. This constant movement is what makes the market exciting. For some investors, penny stocks are like undiscovered gems. For others, they are speculative bets. But for everyone, they are a reminder that the stock market rewards knowledge, patience, and calculated decisions. By the end of this exploration, one thing becomes clear. A low share price does not automatically mean it's a bad stock, and a low share price also doesn't guarantee future success. What matters is understanding what you're buying. A $1 stock could be a future winner, or it could be a sinking ship. Your job is to study, question, and think like an investor, not a gambler. In upcoming videos, we will look at individual U.S. companies trading around $1, analyze what they do, and break down whether they show signs of growth or warning. So stay with me as we continue learning how to spot the difference between a potential opportunity and a dangerous gamble. So as we move toward the end of this video, let's take a moment to step back and reflect. We've explored what $1 stocks are, why investors get attracted to them, and why they can be both exciting and dangerous at the same time. Yes, these low-priced shares can offer big returns if a company turns things around, launches a successful product, or attracts new investors. But that same low price is often a signal that the business is struggling, under pressure, or still unproven. That's why knowledge is your shield in this game. Instead of chasing hype, focus on research. Instead of rushing in, think long-term. Instead of betting everything, manage risk wisely. The stock market rewards patience, discipline, and understanding, not fear or greed. If you're planning to explore penny stocks, do it with awareness and only invest what you're comfortable losing. Treat them as learning opportunities, not guaranteed jackpots. Now I want to hear from you. Would you consider buying a $1 stock? Do you see it as potential or too risky? Share your thoughts in the comments and let's discuss it together. If you want more videos about cheap stocks, growth stocks, or fundamental analysis, hit like, subscribe, and turn on the bell so you don't miss the next breakdown, where we'll analyze real $1 companies in detail. Your support encourages me to bring more deep research and valuable market insights. Thank you for watching. Stay curious, stay smart, and I'll see you in the next video.